Ladies and gentlemen, Asian guy here. Stop what you're doing. Put down the coffee. Close the trading app. Turn off CNBC. What I am about to show you is not a market event. It as a crime scene. This is a financial assassination in broad daylight, and the mainstream media is actively gaslighting you while the vaults are being cleaned out behind your back. Russia just took 5,000 tons off the table. Not may have, not considering, not allegedly. It's gone. And that one single move just snapped the mechanical spine of the global financial system. This is not about politics. This is not about war. This is not about sanctions. This is about atoms leaving the system while you're being fed digits on a screen. While Bloomberg is telling you inflation is cooling, while CNBC is celebrating soft landings, while Wall Street economists are high-fiving each other on TV like trained seals, the physical market is screaming, and that scream does not come from opinions. It comes from flow. It comes from drains. It comes from metal that does not come back. 5,000 tons. That is not a trade. That is not a hedge. That is not portfolio rebalancing. That is a strategic extraction of the plumbing. And here's the part they don't want you to understand. When physical material disappears at that scale, price becomes irrelevant. The screen becomes a lie. The quote becomes theater. The market becomes a rigged casino with the lights still on. This move detonates the entire paper derivative complex. Quietly, mechanically, surgically. No headlines, no panic, no alarms. Just a slow-motion decapitation of the system, while retail investors are arguing on Reddit about candlestick patterns. This is how financial empires actually die. Not with fireworks, with inventory withdrawals. The public thinks wealth is numbers. The institutions know wealth is atoms. And right now, the atoms are leaving. This is why your bond market is convulsing. This is why the repo market is screaming for injections. This is why the dollar is acting drunk. This is why central banks stopped talking and started hoarding. Because the physical layer of the system is now being stripped. What you're watching is the early phase of financial Armageddon, not because the screen says so, but because the plumbing says so. And the mainstream media is not confused, and they are lying. They are running interference. They are publishing ghost signals and hallucinations, while the real market, the one that actually matters, is being carved up behind the scenes. This is the moment when smart money stops speculating and starts evacuating. And if you're still holding only digits, stocks, bonds, ETFs, derivatives, you're standing inside a burning building arguing about the wallpaper. What Russia just did was light the fuse. And everything that follows from here is mechanical. What you're witnessing in these markets is not organic, it is not emotional, and it is absolutely not driven by investor sentiment. This is mechanical execution. This is code. This is leverage. This is algorithmic V-shocks ripping through a paper-based structure that was never designed to withstand physical stress. The public still believes markets are people clicking buttons. They are not. Markets today are machines trading against machines, enforcing outcomes based on collateral stress, margin thresholds, and liquidity rules written by banks for banks. When the system loses physical backing, when 5,000 tons of real material vanish from the lattice, the machine does not adjust. It malfunctions. And that malfunction is exactly what you're seeing right now. Every time you see a sudden rally that makes no sense, that is not optimism. That is forced covering. Every time you see a waterfall drop on no news, that is not fear. That is collateral liquidation. The mainstream press calls this volatility. That word is a lie. This is structural failure. Bloomberg tells you the move is driven by expectations. CNBC tells you it's driven by growth outlook. Reuters tells you it's technical. They are all publishing ghost signals, narratives generated after the fact to rationalize machine behavior they do not control. The real drivers are invisible to the public. Repo stress, margin calls, inventory drains, clearinghouse collateral adjustments, cross-asset compression trades, and sovereign stockpiling of physical resources that never touch an exchange. When Russia removes 5,000 tons of real material from circulation, the machine does not price that event directly. It reprices everything around it through stress propagation. Like cracking the foundation of a skyscraper, the windows shatter 3 floors up. This is why your charts look insane. This is why markets gap in pre-market, reverse at lunch, then melt up into the close for no reason. This is why gold moves before bonds. This is why silver moves before copper. This is why the dollar surges while treasuries dump. This is why none of it makes sense if you are still looking at the world through headlines. Because the machine is no longer trading narratives. It is trading survival. When physical disappears, paper leverage becomes radioactive. Every contract suddenly needs real backing. Every promise becomes suspect. Every counterparty becomes dangerous. So the machine executes. It sells what it can. It buys what it must. It neutralizes risk at the speed of light. And it does not care who is standing in the way. This is why your pension fund looks calm while the plumbing is exploding. This is why your brokerage app says all is well while vaults are being drained. This is why the public is asleep while institutions are in full evacuation mode. The machine already knows what the news will say tomorrow. The news is written by the machine today, and the machine is telling you the old price structure is dead. The reason the mainstream cannot explain what is happening is because their models assume the system is honest. It is not. This system is a rigged casino built on leverage, rehypothecation, and infinite paper claims against finite physical supply. It only works as long as no one demands delivery. Russia just demanded delivery. That one act alone invalidates decades of assumptions. Because when a sovereign entity moves at that scale, it is not speculating. It is repositioning for a different world. And once that repositioning begins, the machine has no choice but to follow. This is the phase where everything still looks normal. This is the phase where people are still debating CPI prints and Fed speeches. This is the phase where retail is still buying the dip and trusting the screen. But under the surface, the mechanical reality has already shifted. The paper market is now fighting the physical market. And the physical market always wins. The institutions understand this. That is why you are seeing capital flow out of long-duration paper assets and into hard collateral. That is why sovereigns are hoarding. That is why industrial players are locking supply. That is why the vaults are bleeding. The machine is no longer optimizing returns. It is minimizing extinction. And everything you will see on the screen from this point forward will be an artifact of that survival protocol. Now let's talk about the part that completely exposes the lie, the math. Because numbers do not care about your feelings. And they definitely do not care about CNBC's morning show. Right now, you have a global pricing schizophrenia. On one side of the planet, in New York, the screen tells you the metal is trading around $71. On the other side of the planet, Shanghai, Tokyo, Singapore, real physical supply is clearing at $89, $97, $110, even $130, depending on form, purity, and immediacy of delivery. That is not a premium. That is not logistics. That is not shipping cost. That is a structural fracture. In any honest market, this creates an immediate arbitrage. You buy at 71 in New York, ship to Asia, sell at 100 plus, and collect free money. That is how markets are supposed to work. That is how price discovery is supposed to function. Except it's not happening because the metal is not moving. The arbitrage mechanism is broken. And when arbitrage breaks, the market is no longer a market. It becomes a theater production. The screen price is the performance. The physical price is the truth. This is what the public does not understand. Futures markets are not delivery markets. They are leverage markets. They are risk transfer engines. They are derivative casinos. They only function as long as no one demands the chips be redeemed for the vault. When Asia started demanding the vault, the math snapped. Shanghai doesn't care what New York prints. Tokyo doesn't care what the COMEX posts. They are not trading paper. They are securing atoms. And once a region shifts from digits to atoms, that region stops obeying the screen. So now you have this absurd situation where Western markets are quoting prices that no longer correspond to physical reality, while Eastern markets are clearing supply at levels that would vaporize every leveraged short position in the West if the two were allowed to converge. That convergence is what arbitrage is supposed to enforce, but arbitrage requires delivery, and delivery is no longer available. This is the smoking crater. The COMEX can print 71, LBMA can print 72, ETF custodians can print anything they want. But if Shanghai is paying 100 plus for bars, and Tokyo is bidding higher for immediate settlement, the real price of the metal is not the screen, it is the invoice. The arbitrage desks know this, the bullion banks know this, the sovereign funds know this. That is why the metal is not flowing west to east. It is being blocked. Export restrictions, strategic stockpiling, bilateral off-exchange deals, state-to-state transfers, no reporting, no transparency, no market impact. And suddenly, the entire global pricing mechanism becomes a lie that everyone pretends to believe, because acknowledging the truth detonates the system. This is why the divergence keeps widening. This is why the premium keeps growing. This is why the paper price refuses to follow the physical price. The machine cannot allow convergence. Because if the paper price chased the physical price, margin requirements would explode, shorts would be annihilated, clearinghouses would seize, and the derivative tower would collapse in hours. So the system chooses illusion. New York becomes the hallucination. Asia becomes the anchor to reality. And the longer this persists, the more violent the resolution becomes. This is exactly what happened in nickel. This is what happened in energy. This is what happened in shipping. This is what happens every time physical scarcity collides with financial leverage. At first, the screen lies, then the trades stop clearing, then the market breaks. And the reason Russia's 5,000-ton extraction matters so much is because it accelerates this divergence at a speed the system cannot absorb. Those tons are not available for arbitrage. They're not available for lease. They're not available for swap. They're removed from the lattice. which means the Western paper price now floats on thinner and thinner physical backing, while Asia is bidding for what little real supply remains. This is why premiums are exploding. This is why delivery delays are growing. This is why refiners are running at capacity. This is why governments are panicking. The public still thinks this is market noise. It is not. This is the sound of the price discovery engine seizing. Now we move into the plumbing, the part of the system the public is never supposed to see. This is where the fingerprints are. This is where the bodies are buried. This is where the story stops being theory and becomes evidence. Because when the physical layer starts breaking, the first thing that explodes is not the stock market. It is the funding market. And the funding market is screaming. You've seen the injections, 17 billion, 34 billion, then another emergency facility, then another temporary operation, then another technical adjustment. They will never call it a bailout. They will never call it a rescue. They will never say the word panic. But that's exactly what it is. When the repo market needs constant oxygen, it is because collateral quality is collapsing. Not quantity, quality. Paper assets are losing credibility as reliable backing for leverage, because the system knows that if counterparties start demanding real settlement, there isn't enough real material to honor the claims. So the Fed steps in, not to save you, not to stabilize the economy, but to keep the derivative machine from tearing itself apart. This is where the so-called blue whales, like the biggest banks on the planet, begin their quiet repositioning. They don't announce it. They don't warn anyone. They don't file press releases. They just flip. Short positions quietly get closed. Hedges quietly reverse. Exposure quietly migrates. The blue whale flip is when institutions that were structurally short physical assets, betting on abundance, stability, and control, suddenly move to long positions in real collateral. This is not speculation. This is evacuation. They do this while telling their clients everything is fine. They do this while analysts keep publishing buy ratings. They do this while pension funds are still allocated to the same old portfolios. Because institutions understand something the public does not. When physical leaves, the game is over. The repo injections are the smoke. The blue whale flip is the fire. And it is happening now. Why? Because the plumbing is under stress. When Russia pulled 5,000 tons out of circulation, it didn't just affect supply. It affected collateral chains. That material was supporting leverage. It was backing swaps. It was anchoring hedges. It was stabilizing settlement structures that rely on physical references, even when trades are nominally paper. Remove the physical anchor and the system's risk models begin to hallucinate. So the Fed injects liquidity. Not because money is scarce. There is infinite money. But because trust is scarce. Liquidity is the drug. Trust is the disease. The injections are not fixing the problem. They are buying time. And the time they are buying is being used by institutions to get out of the building. This is why you see banks suddenly increasing their long exposure to commodities, real assets, energy infrastructure, mining, strategic materials. This is why central banks are hoarding. This is why sovereign wealth funds are reallocating. This is why export restrictions are spreading. This is the system repositioning for a different phase of reality. And the public is still watching earnings reports. The derivative complex is a tower of promises stacked on top of promises. And the only thing that ever made it work was the assumption that physical supply was always available if needed. That assumption is now dead. So the Fed floods the system with digits, hoping the pressure equalizes before the fracture becomes visible. But the fracture is already visible to those who know where to look. Repo stress, cross-currency basis dislocations, collateral scarcity, unexplained volatility in supposedly safe assets, settlement failures that quietly get rolled forward instead of resolved. These are not coincidences. These are symptoms. The system is no longer stable. It is being managed. And when a system must be managed this aggressively, it is already broken. The blue whales have smelled it. They are not debating. They are not waiting. They are moving. They are converting digits into atoms while the public is still arguing about rate cuts. Because once the plumbing fails, nothing else matters. And now we arrive at the part that absolutely terrifies the institutions. Industrial demand and vault reality. This is where the fantasy of there's plenty of supply finally dies. Because the physical metal is not just being hoarded by governments. It is being consumed by industry at a rate the paper market never modeled. Take Samsung's new solid-state battery technology. This is not a concept. This is not a prototype. This is production. Each next-generation vehicle built on that platform requires nearly 1 kilogram of high-purity silver in its electrical architecture alone. Power management, thermal control, charge routing, safety systems, all silver-intensive, all non-negotiable. There is no substitute at scale. Copper cannot do it. Aluminum cannot do it. Graphene is a lab fantasy. The physics is the physics. Now multiply that by global EV production targets. Then add solar expansion. Then add grid upgrades. Then add defense manufacturing. Then add AI data centers consuming power infrastructure like a small country. This is not cyclical demand. This is structural demand. And here's the problem. The mining pipeline cannot respond. New production takes 7 to 12 years. Permits, financing, infrastructure, labor, refining, all constrained. And much of the existing supply is being locked by state contracts that never touch public exchanges. At the same time, China quietly imposes export controls. Not headlines, not press conferences, just paperwork and silence. What used to flow into the open market is now diverted into strategic reserves, domestic industry, and bilateral agreements, which leaves the Western exchanges with a shrinking pile of deliverable material. Now look at the vaults. COMEX registered inventory bleeding month after month. Asahi drained. LBMA transfers accelerating. Bars leaving, not returning. This is not inventory management. This is evacuation. When metal leaves a vault in this environment, it is not coming back. It is being absorbed by entities that do not participate in the paper system. And once it leaves the derivative lattice, it becomes invisible to price discovery. That is why price stops behaving normally. That is why premiums explode. That is why futures stop reflecting reality. Because the metal has become unobtainium. And here's the word institutions will never say on television: war metal. Every modern military platform, drones, guidance systems, satellites, radar arrays, secure communications, all depend on high-purity conductive materials that cannot be replaced at scale. Industrial policy is now national security policy. Resource control is now military doctrine, which means the open market is no longer in control of supply. That alone would be enough to destabilize the system. But add Russia's 5,000-ton extraction on top of this, and now you have a full-blown physical crisis. Not a pricing crisis, a material crisis. The screen is lying because it has to. If the screen told the truth, the system would collapse instantly. So the illusion continues. The vaults drain, the factories consume, the governments hoard, and the public is told everything is fine. This is why this phase is so dangerous, because it is quiet, because it looks normal, because people still believe the price they see. But the physical market has already moved on. This is the moment in every financial cycle where the digits lose authority and the atoms take over. And once that transition completes, there is no going back. This brings us to the end game. Not next week, not tomorrow morning, not after the next CPI print, but the 2026 battlefield that is already being drawn. This is the phase where you stop thinking like a trader and start thinking like a survivor. Because in every monetary reset, in every systemic collapse, in every currency event in history, there is one brutal constant. Those holding digits are the last to know. Those holding atoms are the first to sleep. The system is transitioning from digits to atoms right now. That is the only signal that matters. So here is the survival guide. Simple, ruthless, mechanical. The 5 and 200 rule. Rule number 1. At least 5% of everything you own must exist outside the financial system. No counterparty, no leverage, no promises, no screens, only custody. Rule number 2. At least 200 days of expenses must be insulated from currency risk in real assets, hard collateral, or tools that function when digits fail. Not because the world is ending, but because the system is changing layers. Every generation lives through one of these. This is yours. The institutions are not preparing for growth. They are preparing for volatility of reality. The blue whales have already moved. The vaults are already draining. The arbitrage is already broken. The plumbing is already cracking. The only question left is whether you transition before or after the screen forces you to. Because when the repricing finally becomes visible, when the paper facade can no longer contain the physical truth, it will not be a gentle adjustment. It will be a violent reconciliation. And at that point, there are no bailouts for people who stayed in digits. So you step out of the rigged casino. You stop believing the ghost signals. You stop trusting hallucinations. You move to the side of history that survives. Because wealth in the next cycle will not be measured in returns. It will be measured in positioning. And the only positioning that matters is whether you are standing in atoms when the digits reset. This is not speculation. This is mechanical reality. And now you know what the machine already knows. Well, I will see you on the other side. Like, subscribe, and share.